So good afternoon, everyone. My name is Maurya Hanspal, and in this session, we'll continue our sessions on valuations. And this is the valuation session completely on valuation. And here, we'll be continuing our sessions on the valuation techniques, valuations. So what exactly we did in the previous sessions? In the previous session, we started to talk about the various methods of valuations. And we got to know that there are basically three heads of valuations under which there are different techniques or subheads of valuation. First is your income approach. The second one, we have the comparables approach or the relative valuation approach. And the third one is the asset-based approach. Okay, so the first approach of valuation, we completed the income approach. In the income approach, we talked about the discounted cash flow analysis or the DCF analysis. We talked about the capitalization approach, and we talked about the discounting profit approach. Out of these three approaches, discounted cash flow approaches is the most widely used approach. In 99.9% of the scenarios, DCF approach is used. Then we talked about the capitalization approach and the profit discounting approach. So when we talked about the discounted cash flow approach, our approach was to calculate the future cash flows of the company and then discount it by using a discount rate. A discount rate is nothing but your weighted average cost of capital or the cost of capital or the overall cost of capital. In simple sense, we mean the minimum return which all the investors are expecting from their investment, be it equity shareholders or debt holders, because both of them have contributed their money in their own way to the company. Equity shareholders want a return, and debt holders also want a return in the form of the interest payments from that. So then we discounted the future cash flows and we calculated the present value of the future cash flows. And then we assumed that we had invested certain amount. And from that amount, that is our investment amount, and from the sum of the present value of the future cash flows, we calculated the net present value. The net present value was nothing but sum of the present value of the cash flows minus the investment amount. And we got to know that we have to always accept a company or a project having a positive net present value. It means ultimately we are gaining on our investment. And if a company or a project is giving us a negative net present value or a zero net present value, we have to reject that project. Then we got to know that the discounted cash flow analysis was basically being used for the growth companies, the companies that are at a growing stage, and not for the mature companies. And for the mature companies, an approach called the capitalization approach is used, where we use your geo mean or geometric mean. But we also know that the context of the theoretical concept of a mature company is the company which is a cash cow now. The company has no future prospects, the company has no diversification plans, expansion plans, and the only option available with the company is to sell off the assets of the company or to pay the dividend and to sell off and go away. But that we can say is only possible in case of a theoretical scenario. And that is where the capitalization approach, I personally believe, is of a theoretical concept and not of a practical concept. Because even these top companies, the top market capitalized companies like Reliance, Tata, HDFC Bank, ICICI Bank, all these companies are still going for diversification plans, expansion plans, going into the EV theme, the clean energy theme, renewable power, hydrogen power, and new emerging themes. So why can't we say these companies are into the state of dissolution or liquidation? As per the theoretical concept and scenario, it's fine, but in the practical scenario, the capitalization approach, stating only for the mature companies, does not work. So the discounted cash flow analysis works for both the growth companies and the mature companies as well, right? And the third approach that we talked about was the worst of all these approaches, the profit approach. Because ultimately in this approach, it's same as the cash flow approach. We're trying to project the future profits and then discounting it with the discount rate. But the profit approach can be manipulative. How? For example, if I have made a profit by selling certain items at a margin to someone. So 200 rupees ka I got a profit. So no matter I received that actual 200 rupees or not, I would be showing that 200 rupees in my books of account as profits. So out of that 200 rupees, there can be some debtors also, some kinds of bad debts also. So just assume the debtors are of 150 rupees. Okay, and 50 rupees is the actual amount which I have received. But still the company would be showing 200 rupees as profitability, and that can make the company being overvalued. But in the cash flows, it would just be shown as 50 rupees. Because when we talk about the cash flow statement or tend to project the future cash flows, it shows the actual cash already received. It excludes the impact of bad debts or debtors. Okay, so that is what the cash flow can give you, a more realistic measure of the valuation of the company, right? Then after that, we started our discussion with what? Yeah, we started our discussion with your comparable approach. The comparable approach is also called your relative valuation approach. So, be it the comparable approach or relative valuation approach, we further have two approaches within that. The first approach is the transaction multiples approach, and the second approach is your simple multiple approach or dealing approach or your company's approach. So when we talk about the transaction approach, we talk about mergers, acquisitions, amalgamations, and takeovers, and we use the multiples involving EV, that is your enterprise value, and not electric vehicles. Then in your dealing comparable approach, like we tend to use PE multiples, PB multiples, and all those multiples. We started our discussion on talking about the like the multiple approach, the company comparable or like dealing multiple approach. Firstly, we talked about the earnings per share or EPS. So when we talk about the EPS of the company, the formula says your net profit or the profit after tax divided by the number of outstanding shares the company has. So if the company has paid dividend, so basically like what we can do, like we have the earnings before interest and tax, EBIT, or as we call the operating profit of the firm. We can subtract the interest payments, then the tax payments, and then the dividend payments only if the company has declared a dividend. And once we subtract the dividend, so as a layman, like we can call it as a PAT, or we can PAT by mean profit after tax, or like we can call it as EACS. E stands for earnings available to common shareholders. So our EPS ratio, it basically tells you how much is the growth of the company as per the shares the company has, or how much profitability is contributed to that shares. And again, higher the EPS, it is better for the company because ultimately the company is making more profit as per the shares the company has. Then, deriving from the EPS, we talked about the price to earning ratio or the PE multiple. So it is the current market price of the share divided by the earnings of the company. The earnings of the company is absolutely like depicted by the EPS of the company. So the ratio tends to be the price of the share divided by the EPS of the share company. Okay, so people tend to say that EPS, the price of the share, the PE ratio must be as low as possible. And when would be the PE ratio would be as low as possible when the EPS is high and the market value of the share is low. So in that case, we can have a value stock, the company that can give return in future. But on the other hand, not all companies give you returns in future. Like for that, you have to see the other scenarios and other ratios and metrics as well. But if the P ratio is very high, it means the growth is very low, the EPS is very low, the earnings is very low, but the market price of the share is very high. In that case, the company can be overvalued, or the company must justify its operations as per the other valuation metrics. Then we talked about the PB multiple or the price to book value multiple. So when we talk about the PB multiple, it shows the current price of the shares in the numerator and the book value in the denominator. Book value is nothing but your assets, the cost price or the acquisition price of the assets minus the depreciation amount, and you get your book value, which is also called your carrying value. So if the PB ratio is very high, it means the assets that the company has is very low and the price that the company is commanding is very high. It can be inferred that maybe the company is overvalued and the company must justify its valuation. But on the other hand, if the PB ratio is very high, is low, sorry, it means the assets that the company has is very high and the share price of the company is very low. It means that the company is undervalued and can become a potential multi-bagger stock like when it attains its full value. Okay, but that we have to see because every small company or every cheap company, it does not become a good company in the future. So that scenario also you have to take into consideration. Okay. Let's talk about something as the dividend yields. First, let's talk about dividend per share. There's nothing shows you how much dividend has been paid, or basically as per the earnings of the company or the EPS, the dividend per share. Give me a second. Okay, so basically क्या होता है? You have to calculate DPS ही हो गया basically और dividend per share. तो आउट ऑफ द ईपीएस जो कंपनी की अर्निंग्स हैं तुम उसमें से तुम कितना डिविडेंड पे कर रहे हो, दैट इज योर डिविडेंड पर शेयर. बट डिविडेंड यील्ड इज समथिंग डिफरेंट. डू नॉट कंफ्यूज द सेम. But dividend yield may means the annual dividends that have been paid in an year divided by your current share price, current market price. So see, like when you calculate dividend now, dividends are always paid on the face value of the share and not the current market price. But here you might think that current market price लिखा था मतलब कि dividends हम market price में नहीं, हम market price पे अभी भी pay नहीं कर रहे. The interpretation of this ratio is different. Okay, so take into consideration dividend is always paid on the face value of the share and not the current market price of the share or not at the value in which you bought that share. Okay, but dividend yield का basic में क्या है? How much dividend has been paid as compared to the current share price of the company. अगर शेयर प्राइस कंपनी का 200 है एंड 100 रुपए का डिविडेंड पे कर मतलब 50% ऑफ द करंट शेयर प्राइस का डिविडेंड, 50% ऑफ द करंट शेयर प्राइस हैज बीन पेड एज डिविडेंड. सो इट डज नॉट मीन कि शेयर प्राइस की परसेंटेज का डिविडेंड पे करा गया. इट इज जस्ट कंपेयरिंग और एनुअल डिविडेंड्स ओवर द टाइम, ओवर द 1 year पीरियड, 2 year पीरियड, 5 year पीरियड, ओवर द करंट शेयर प्राइस ऑफ द कंपनी. दैट इज द कॉन्सेप्ट ऑफ डिविडेंड यील्ड. ठीक है. Now let's talk about something called as revenue multiples. In revenue multiples, you have something called price to sales. People also tend to call it as your total market capitalization of the company, like divided by the total revenue. Okay, that is something like it means just the same thing. So, price to sales metric can be most popularly used for the loss making companies. Why? Because ultimately, why are the companies making losses? The companies are not making losses, the startup tech platforms, as we popularly call them. These companies are not making losses, are making losses not because they have no sales. The main reason is that expenses are more than sales. Their capital expenditure is more than sales. Okay. So in order to value these companies, because ultimately they have losses. Okay, like मतलब कि उन companies की कोई value नहीं है, उन value है, but these companies have losses and negative cash flows. So DCF analysis cannot be used. Your PPB multiple cannot be used. Your price to book value might be used, like if the company has assets. But these loss-making platform tech companies, these are tech companies. They like do not even have assets. And how to use the revenue multiples, how to use that PB multiple for that. But these companies have sales. So on the basis of sales, these companies can command a price also. Okay, so they can use the price to sales ratio. And they can compare the, like for example, the price to sales ratio of a comparable companies too. Okay, so they can of a comparable company. So this is A, my own company. Two is of a comparable company, or like you took the average of the industry, and the sales by you is 2,000 annually. So the price that you can command is like 4,000 rupees, like for your share. So this is how people tend to use the price to sales ratio. Like some people say the price to sales ratio is vague because all of these top platform companies like Zomato, Paytm have already corrected more than 50-60%, and these companies are not good. Okay, but since if a company is loss making and you want, for that case, your price to sales metric can be used if you want to calculate the share price of that company. Okay. The other multiple in the or revenue multiples, which can also be somewhat related to transaction multiples, like but not wholly, but it's a revenue multiple. Let me write it once again. EV to sales. EV is an enterprise value. Now, if you want to know the enterprise value of the company, like maybe for the purpose of mergers, acquisitions, and all, because all those mergers, acquisitions can be done on the basis of enterprise value and not the market value. So, before understanding EV to sales, let's try to understand the difference between the market capitalization and enterprise value. Market capitalization and the enterprise value. Okay. So when we talk about the market capitalization of the company, it only involves the equity shares of the company. It does not take into consideration the debt of the company, the cash flow position of the company. So if a company A is acquiring a company B on the basis of the market capitalization, it might appear to be cheap because this company has not taken into consideration debt. अगर कंपनी के पास डेट है ही नहीं, in that case the market capitalization metric is good. But if the company has debt, then use the enterprise value because it takes into consideration both equity and debt and also the cash flows of the company. Okay. Because ultimately, market capitalization, there has been some instances in the past where people purchase the companies on the basis of the market capitalization. And once they purchase the companies on the basis of the market capitalization, they realized that those companies have huge debt also. And since they are the new owners of that company, they have to pay debt also. And then they realize, काश हम debt value पे company को purchase कर लेते या company को purchase ना करते. That is why the enterprise value in some scenarios can be more than the market capitalization if the company has debt also. So a question arises, would you buy a company having a positive enterprise value or a negative enterprise value? And this question is asked in a large number of interviews as well. The interviewer, he asks you that whether you want to buy a company with a positive enterprise value or a negative enterprise value. And they're like, people are concerned like with positive things, like they want positive cash flow, positive profits, positive P ratio, EPS, and they say that a company with a positive enterprise value. And the answer gets wrong. Always accept a company with a negative enterprise value. Why? Because like what is the formula for the enterprise value? It's the equity of the company, debt of the company. You also include like minority interest minus cash. And what is like what is the minority interest? Minority interest are the minority shareholders who hold less than 20% of the company. Okay. तो अगर ये वैल्यू एंटरप्राइज वैल्यू मतलब कि नेगेटिव कब आएगी जब कैश इज मोर देन एवरीथिंग एंड कैश होना तो अच्छी बात है जितना कंपनी के पास कैश इट मींस द कंपनी कैन पे ऑफ द डेट आल्सो द कंपनी कैन गिव टू इक्विटी शेयर होल्डर्स आल्सो एज डिविडेंड एंड कंपनी को क्या पता है कि इक्विटी रेज करने की भी नीड नहीं बिकॉज कैश बहुत है कंपनी के पास right? So I would personally accept a company having a negative enterprise value. It sounds something absurd, but that's the truth. Okay, that is a scenario that you should also look into. Okay, so coming back to EV2 sales. So this EV is taking into consideration that both equity and debt. Is taking into consideration your both equity and debt. Okay. Up again, you might have an EV multiple of the industry or a particular company that you are comparing your company with, or an average EV to sales. Like just assume it's 5. You have to calculate the enterprise value for your company or for the target company because you are acquiring that company. Sales of that company is 10,000 rupees. Just an example. So the EV of that company will come out to be 50,000 rupees. The value of that company is 50,000 rupees. At 50,000 rupees, you can purchase that company. That is your EV to sales metric. अब यहाँ पे प्राइस टू सेल्स की हमने बात करी. EV to revenue or EV to sales is the same. But EV to EBITDA, EV to EBITDA, these are the transaction multiples. EV to EBITDA की बात करते हैं हम. EV to EBITDA. In transaction multiples, we have called EV to EBITDA. EV is enterprise value, EBITDA is earning before interest, tax, D is for depreciation, A is for amortization. Why Nykaa was on a hike? Because Nykaa was one of the only tech platform companies jiska EBITDA was positive. Okay, why? Because it outlooks the consideration of depreciation and amortization. Because depreciation and amortization अगर तुम include नहीं कर रहे, it means तुम capex को तुम include नहीं कर रहे. And capex को अगर तुम नहीं कर रहे, because capex is like the greatest reason why these companies are loss making. मतलब तुम depreciation and amortization को तुमने exclude कर दिया. मतलब EBIT में you added back the depreciation and the amortization amount. Yes, ये सीधा तुमने जब तुम revenues में से expenses को minus कर रहे थे, तुमने depreciation and amortization को minus नहीं कर. Again, this metric can be used to calculate the enterprise value of the company. You might have EV to EBITDA of a comparable company 5. EV अपनी कंपनी को निकालना है, EBITDA अपनी कंपनी का 100 है, तो 500 करोड़ की वैल्यूएशन होगी कंपनी की. But what does this indicate? It indicates how much your EBITDA is supporting your enterprise value. Profit कंपनी का कितना सपोर्ट कर रहा है enterprise value को, basically. And it also includes a concept of the payback period, just like the P ratio. The P ratio में क्या था? P ratio, it just took into consideration in how much time your investment would be recovered only in terms of equity, right? So that was your P ratio, price to earning ratio. तो बस equity shares को take into consideration करता है. But enterprise value, it takes into consideration both the equity and the debt value ultimately. So it is basically telling you in how much time all the capital providers, be it your equity holders, your debt holders, will get money from the capital invested into the company. एक payback period निकल के आ जाएगा. अगर 5 साल का किसी कंपनी का EV to EBITDA का रेशियो आ रहा है, so it is basically indicating that the company might take 5 years to pay back your investment. Okay. But now like people also like start to fight. Okay, like the EV to EBITDA ratio should be high or low. If this EV to EBITDA ratio is high, so what does it indicate? If your EV to EBITDA ratio is high, it means the EBITDA of the company is low. Mathematically, like when this ratio would be high, when your denominator is low and your numerator is high, EBITDA कम है and EV ज़्यादा. It might indicate that the company is overvalued. But that you have to see other reasons or other concerns to justify this high valuation. And when this ratio can be low, if the EBITDA is very high, बहुत ज़्यादा है denominator, but the enterprise value of the company is very low. At that time, people might say that the company is undervalued or might be a value stock for future. Okay, so these things have to be taken into consideration while using the EV to EBITDA ratio, and you cannot say that your company is high or low. The best way is to calculate your EV to EBITDA of the comparable industries, all the of the comparable companies like within the same industries. If your name of your IT company is A, then calculate EV to EBITDA of Infosys, TCS, Wipro. मान लो इसका 2 है, इसका 3 है, इसका 4 है. Like then take the average 4, 5, 6, 7, 8, 9. 9 by 3. 3 is coming as the average EV to EBITDA. 3 is average and तुम्हारी company का EV to EBITDA is coming as 2. It means that your company is undervalued because it is below the industry average. अगर 4 आता है, it means your company is overvalued. It means above the industry average. अगर 3 आता है, it is at the average. So this kind of analysis like you'll have to do. Okay, that is something you'll have to take into consideration as well while using the EV to EBITDA ratio. The same thing happens when we're calculating EV to EBITDA R. This R extra stands for rent. इसका मतलब है that you have excluded the rental expenses also. Sometimes I personally believe if you are excluding everything, ठीक है, तो मतलब क्या होगा? That you are just taking into consideration the revenue of the company. That's it. क्योंकि तुम सब कुछ एक्सक्लूड करे जा रहे हो, right? So you're just considering the kind of the revenue for the company. So how can it be an accurate measure? Till depreciation and the amortization is justified because those are the capex and that the company has to do, and that will give return to the company in future. But rent is something like which should not be. Now you have EV to invested capital. It's nothing but enterprise value company के divided by total invested capital. मतलब जितनी कैपिटल कंपनी में है, इज इट जस्टिफाइंग और एंटरप्राइज वैल्यू? कंपनी में इक्विटी इन्वेस्टमेंट्स हो सकती हैं, कंपनी की डेट इन्वेस्टमेंट्स हो सकती हैं, एंड व्हाई हैव पीपल इन्वेस्टेड देयर इक्विटी एंड डेट इनटू द कंपनी? What can be the main reason, like why like people have invested their equity and debt in the company? The main reason because they want some return, and ultimately they saw the enterprise value of the company. उनको लगा कि कंपनी अच्छा परफॉर्म करती है, and that is why they invested into that company. ठीक है, that must be like justified as well. So your price to earning ratio, PB ratio, dividend yield is not a multiple basically. It was like just in general, but like people tend to talk about like dividend yield also. Price to earning ratio, your PB ratio, there are multiples. But specifically like when we talk about the revenue multiples, हम specifically बात करते हैं revenue multiples के बारे में. You talk about price to sales and EV to sales. Okay. Then you have your like transaction multiples में some called, you have your EV to EBITDA. EV to EBITDA R is rent, जो मैं मानता नहीं मतलब ज़्यादा इंपॉर्टेंट मेट्रिक है. कंपैरेबल एनालिसिस में बात कर ले, then EV to like invested capital you have. Okay, so like more